Okay, we will go ahead and get started now. Good afternoon. My name is Jessica Tiltman, and I am an assistant dean at GW Law School, where I teach a course in anti-corruption and compliance, which is part of the law school's government procurement law program. I want to welcome and thank you for attending today's program, Deterring Fraud, Corruption, and Mismanagement in COVID Stimulus Programs, which is co-hosted by the Coalition for Integrity. Now, let me give you a brief overview. The COVID-19 pandemic has created global challenges for governments and individuals. Beyond the almost unprecedented upheaval of our daily lives, the pandemic has had a tremendous impact on government operations and spending as it has attempted to address the fallout from the crisis. Anytime a government has to spend large sums of money very quickly to respond to an emergency, it becomes even more vulnerable to fraud, corruption, and mismanagement. Whether it's a natural disaster or war, the risks are inevitably the same. Transparency often decreases, internal controls are reduced, oversight mechanisms are either overlooked or poorly implemented, and government officials are often willing to look the other way just to get the job done. The pandemic is no different here. We've already seen significant abuse of the programs and systems that were designed to help individuals and companies weather the challenges posed by the pandemic. And these challenges, including fraud, corruption, and mismanagement, are what we will be discussing today. How can the US government better detect, prevent, and mitigate abuses of the COVID stimulus programs? Now, for those of you that are not familiar with the stimulus programs, here's a quick overview. The COVID stimulus includes four major pieces of legislation passed in March and April of this year, addressing the COVID-19 health crisis and its economic fallout. The most well-known of these stimulus packages is the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, which passed with near unanimous support by Congress, which quite frankly demonstrated that even in these times of political polarization, there is an awareness of the dire situation and a need for quick action. It's been referred to as the largest and most sweeping emergency aid package in US history. It initially allocated $2.1 trillion in relief and stimulus funds, with subsequent legislation adding $484 billion to CARES Act funding. A few notable provisions: direct payments to Americans making less than $75,000 a year, $659 billion in total funding for the Paycheck Protection Program for small businesses, $500 billion in loans and grants for larger businesses, including roughly $25 billion to passenger airlines. It also provides for a multifaceted oversight and enforcement mechanism, which is designed to detect the fraud, waste, and abuse in connection with the distribution of these funds. We're going to learn a lot more about that today. Now, the problems that we have seen in the other emergencies are present here too. GAO reported that stimulus payments were made to roughly 1.1 million deceased individuals, amounting to almost $1.4 billion in lost funding. And the Justice Department has already brought charges against at least 82 individuals in 56 cases for Paycheck Protection Program fraud in the last 6 months. A recent Project on Government Oversight report found that recipients used money to buy Lamborghinis, go to strip clubs, take gambling trips to Vegas, purchase yachts, and use it for other reasons which are clearly prohibited by law. Today, we are joined by an esteemed group of panelists who's going to talk to us about these risks and what the government is doing to try to reduce the risks, along with some other additional details about their experience with the programs and the additional fraud that has been uncovered through investigations. So first up is Robert Westbrook, who's the Executive Director of the Pandemic Response Accountability Committee, or the PRAC. Lee Bacon is a special agent of the Small Business Administration's Office of Inspector General. Shruti Shah is the president and CEO of the Coalition for Integrity. Ben Weider is an investigative/data reporter for McClatchy's Washington Bureau. And Chris Cummings is the founder and CEO of Curiosity Media and a PPP loan recipient. So we're going to go ahead and kick this off with Shruti. In the meantime, if any of you have any questions, I implore you to ask them in the chat function that's available to you during this program. Go ahead and ask them, and we're going to try to get to as many of them as possible to ask our panelists during this program. So Shruti, perhaps you could provide our attendees with a high-level overview of the importance of oversight and accountability during an emergency when stimulus is involved.
So thank you, Jessica, and thank you to all of you for attending today. I also especially want to thank George Washington University School of Law, and particularly the Government Procurement Program, and Jessica Tillipman for co-hosting this program with the Coalition for Integrity today. For those of you who don't know us at the Coalition for Integrity, we are a nonprofit based in Washington, D.C., and our mission is to reduce corruption and increase integrity and transparency in the public and private sector. Therefore, trying to provide recommendations to prevent fraud, waste, and abuse in the stimulus program falls within, I would say, our mission. And as Jessica pointed out, this is one of the largest stimulus programs in US history. Uh, when compared to the last stimulus, the 2009 American Reinvestment and Recovery Act, which was about 840 billion, which was a third of the size of the current stimulus. To put it into perspective, the CARES Act package alone, and obviously the other pieces of legislation, they amount to 3/4 of our expected tax revenue for the year. So the potential for fraud is stimulus, in the stimulus is great. And we've already seen numerous stories coming out of people trying to defraud the PPP loan program in particular. Over a few days ago, we saw that Wells Fargo fired over 100 employees because they were trying to fraudulently obtain loans under the PPP program, which was meant for small businesses. We've seen many stories. Justice, you pointed out the Justice Department stories, but I also want to point out U.S. attorney offices across the country have also indicted several people. In Texas, a man obtained a PPP loan while claiming he had 120 employees to support when he had none, and he used the money, among other things, to buy a Tesla. There are people in Florida who obtain, I want to say, around 17 million in PPP loans and use the money to buy expensive jewelry and Gucci clothes. In Virginia, where I live, a couple was arrested at the airport because they had fraudulently obtained over $1 million in PPP loans and were trying to escape the country. Now, we've generally seen that, government programs, or at least experts tell us that government programs have a fraud rate of 5 to 7%, which in terms of this stimulus amounts to about 135 billion to 189 billion, which is huge. Of course, the fraud rate can be brought down with effective oversight. And all of these news reports of fraudulent behavior pose a real tangible harm in the stimulus program. Every dollar that lines the pockets of fraudsters does not go to the intended beneficiaries. It means businesses may go under, workers may lose their jobs and their health insurance, and it'll actually compound our misery during this pandemic, which is why effective oversight is so important. In the last stimulus, many news reports came that the fraud rate was brought down to less than 0.5%, which would be great. As you pointed out, the CARES Act has several oversight bodies: the Special Inspector General for Pandemic Relief, the Pandemic Response and Accountability Committee, and of course, we are thrilled to have Bob Westbrook with us today. And really the Congressional Oversight Commission. It also allocates more money for the Government Accountability Office. And of course, we have the House Committee and the Informal Senate Committee also overseeing the pandemic relief funds. Again, all of these are very important, particularly in terms of the role of the PRAC, the Pandemic Response Accountability Committee, because they also have a transparency function. I mean, on their website, you will be able to track government spending, which is so crucially important. As far as the Coalition for Integrity is concerned, in June of this year, we issued a report called Oversight is Better Than Hindsight, where we looked at the oversight provisions of the CARES Act, and then we actually reviewed work done by inspector generals in the past stimulus, both the TARP and the Recovery Act, and also the work done by IGs in Iraq and Afghanistan reconstruction to come up with recommendations that would improve oversight. As all of you know, Congress is actually in the midst of negotiating a new package. So let me start with some of our recommendations for Congress. I would say our number one recommendation is that the money allocated for oversight is woefully inadequate. When I compare the money allocated for the Special Inspector General for pandemic relief, the SIGPER, the money allocated is half the money that was allocated for the Special Inspector General for the TARP. Which really makes it inadequate because they are overseeing about the same amount of money, 500 billion. Similarly, the money allocated for the PRAC committee is I want to say, the same as the money allocated for the recovery board, though it's overseeing 3 times the amount of stimulus funds. Speaking truly as an accountant, money allocated for oversight is always well spent. I was looking at the Special Inspector General for the TAPS website, and I discovered that in 2019, that office recovered 900 million against a budget of 23 million, which represents a return of 39 times over. So again, you can see it's absolutely good money if you invest more money in oversight. Our second concern was the term of some of these oversight bodies. The term of the Special Inspector General ends in 5 years. So the term ends in 2025, which I would say is too soon. If you look at the Special Inspector General for the TARP, that office still exists today. It would be better if the term ended when the last monetary obligation under the CARES Act closed, which is when the last loan was repaid or the last contract expired. It would be even better if the term ended when all the audits and investigations were to be closed, which would be a longer term. Our third point is that Congress should really, as they are negotiating the new package, enact for-cause removal protections for inspectors general. In the past few months, we have seen numerous cases of inspectors generals being terminated or removed, and some would argue they are for retaliatory actions. If the Inspector General for the Postal Service already has for-cause removal protections, so there is precedent for that, and these should be extended to all IGs so that it would allow them to do their work independently, make recommendations without any fear of retaliation. Finally, I would say one of the most important things for us is enhancing whistleblower protections. The US has a patchwork of whistleblower protections for federal grantees, for federal employees, for other private sector employees. The CARES Act, unlike the Recovery Act before it, the past stimulus, does not have whistleblower protections baked into the act itself, and we think it should. Whistleblower protection should be extended to everybody, any individual who reports misuse of stimulus funds, whether they are recipients of federal dollars or not. This is important because IGs really depend on people who want to come out, speak the truth, and provide information on fraud. So these are some of our recommendations which are crucially important for Congress. We have a few recommendations for the administration and of course for IGs themselves, and I'm going to run through them really, really quickly. For the administration, our most important recommendation is that we really do want them to be responsive to requests for information from IGs, and we want them to take recommendations made by inspectors general very seriously and implement them or provide a reason as to why they are not implementing them. And then we want the administration and federal agencies to have a presumption towards transparency. More eyes on information would mean that fraud is detected earlier. And unfortunately, we've already seen a tendency towards transparency. If you recall earlier, a few months ago, the Treasury Department had refused to provide information on PPP loan recipients. And under pressure from the media and pressure from civil society and several others, they agreed to disclose names of all recipients over $150,000, which is good, which means we also should keep the pressure up on the administration for transparency. The other thing is that the administration should absolutely nominate people for vacant inspector general positions. There are, I want to say, at least 4 acting inspector generals in the Pandemic Response Accountability Committee. And acting inspector generals, many would believe, lack credibility and permanence to do their job with independence thoroughly and really set strategic plans. I would also say that one other important recommendation for the administration is that anybody who receives federal dollars should be made to provide information on their true beneficial owners. That is the ultimate natural person who directly or indirectly controls the organization, which is really important to deter conflicts of interest and root out corruption. And under the CARES Act, the Federal Reserve can conduct closed door meetings. So we really do want them to disclose transcripts of those meetings. For IGs, we, of course, our most important recommendation is we want them to conduct thorough audits, investigations, be honest and transparent in their communications and their reports, even if it means being critical of the administration. We want them to coordinate amongst the various oversight bodies because they have slightly different but sometimes overlapping jurisdiction, which may mean that smaller programs go under the radar and there's some confusion. So coordination is key. We also do want them to coordinate with state and local authorities. I would say that we want them to adhere to best practices set out by the Council of Inspector Generals on Integrity and Efficiency as it relates to whistleblower protection, protect whistleblower rights, train people on whistleblower rights, and certainly protect confidentiality of whistleblowers wherever possible and to the largest extent possible. I would say the other big recommendation I have is utilize data analytics because these IG offices have limited funds and using advanced machine learning or data analytics to hone in on patterns of suspicious behavior would be extraordinarily useful. Unfortunately, we've noticed that the Special Inspector General in his initial report to Congress already pointed out that they don't have the funds to support an enhanced data analytics office, which is why that fund should be increased for oversight. So as you can see, I could talk about this all day. I'm going to pause there, and I would love to hear from others.
Thank you, Shruti. Okay, so we're going to turn to Bob, who's going to talk to us a little bit about the PRAC and their work and their role in oversight. Bob, thank you.
Great, thank you, Jessica, so much. I appreciate it, and I really enjoyed your opening comments today. Fantastic job of summarizing, I think, the issues that we're dealing with and sort of framing the problem. And Shruti, thank you for the recommendations and your comments. The role of the Inspector General or Federal Inspector Generals has never been more important. I think any American that looks at the news and is keeping up with current events could attest to that. And at the same time, it's never been more challenging. It is a very challenging environment to operate in for a number of reasons. Shruti talked about the dollars involved, right? The CARES Act was a substantial piece of legislation, both in terms of the number of pages. It was a very thick volume of laws in terms of the dollars involved and in terms of the impact on American individuals, families, and businesses. Buried on page 253 of the Act is a very important accountability mechanism. It's for the lawyers, it's section 15010 and 15011. And it establishes the Pandemic Response Accountability Committee. If you remember the news at the time when the CARES Act was being negotiated, originally there was not a provision for an independent accountability mechanism, and there was some talk about that publicly, and late in the drafting process, the sections were added. If you look at the sections, they took the Recovery Act from 2009 and they updated or modernized it to address the situation we're dealing with now. So we have a template to build on, but they made some fundamental changes as well, and there's some key differences. In terms of the governance structure, what the PRAC is a collection of 21 inspector generals. They are the committee. And these are, some of the IGs are statutorily designated. For example, Department of Justice, DOD, Department of Labor, and others are selected by the chair. The PRAC members all have day jobs. They are all very busy overseeing audits and investigations that are not pandemic related. They are all very busy managing some very large organizations that are operating, trying to conduct meaningful oversight and criminal investigations during a global pandemic. And then in addition to that, they've got this additional responsibility to be a member of the Pandemic Response Accountability Committee. The PRAC has permanent staff as well. I'm the executive director of the permanent staff. I'm the former IG at the Pension Benefit Guarantee Corporation. I manage about 19 staff members now, most permanent, some detailees from other agencies. But when the CARES Act was signed on March 27th, we were not given a long time to implement. It was expected we would sprint as soon as the act was passed. And in the law, it gave us 30 days to implement a couple things. One was select the executive director, myself, and second, to establish a website. Shruti mentioned that. It's pandemicoversight.gov, and that has not only federal spending data, but it also has other pandemic-related information. That website is up and running. We've just now implemented and migrated to 2.0, where we've incorporated in additional data from USA Spending. So it's got contract data. It has data, accountability data from the IGs. It's got open recommendations related to the pandemic, for example, and it has oversight reports. It also has a link to SBA's Payroll Protection Program data. And it has, and next month we will be incorporating in data related to the $150 billion coronavirus relief fund that went to the state and local governments for them to dispense. Now, of the members of the PRAC, and I got a question in the chat room, you know, one of the members is the Special IG for Pandemic Recovery, Brian Miller. He's an IG just like the rest of the IGs. So my job as executive director and our staff's job is to conduct and support oversight. The IGs are doing oversight now in their individual offices, and our job is to identify those issues that transcend agencies or transcend programs, and to report on them. Part of our job is to support oversight in this challenging environment. So for example, one of the products we've been working on to help IGs is called an Agile Oversight Toolkit. For those of you that have any familiarity with the government auditing process in GAO or the Yellow Book standards, know that in our world, because our audit reports are public and live forever and have profound impact, those reports take a very long time to publish and issue. And sometimes, you know, audit reports should not have a birthday, but unfortunately, sometimes it takes up to a year for government audit reports to get out the door and be published. We can't have that. Policymakers, the civil society groups, the American public, they need insights now. And so we've pivoted as a community, and it's been fascinating to witness. We've pivoted to agile oversight products to get products out the door in a matter of weeks or months versus a matter of a year. They're not all of them are going to be the breadth and the depth of the larger Yellow Book audits that folks are used to seeing from IGs, but they are nevertheless providing valuable insights. And I'll give you an example on that. So, and I know Special Agent Lee Bacon's going to talk about the PPP program in a little bit, but the audit side of his office has done some pretty incredible work, not only on PPP, but on another program that has seen a tremendous amount of fraud, which is the Economic Injury Disaster Loan Program, or EIDL. They have found, which is astonishing, and there's all of these reports are on our website. I encourage you to go look at them. But they've gotten thousands of hotline complaints from financial institutions that have identified fraud in transactions for the EIDL loan. So these aren't, you know, hotline contacts from just a whistleblower that contacts your hotline. These are, you know, highly credible, highly detailed referrals from financial institutions that have identified fraud through their own data analytics. So we've seen tremendous fraud in the EIDL program that's been reported on, and IGs have recommended to management to examine and fix and correct the internal control deficiencies. And Jessica did a great job of talking about that balance you always have in terms of a crisis, with balancing expediency with accountability and transparency. They've also, in the PPP program, it's the same thing. There's a couple of nice Agile oversight reports there, alerting management to problems in that area. The other major area that we're seeing issues on from a fraud, waste, and abuse standpoint is the unemployment insurance program. The unemployment insurance program went from about $27 billion last year, the Department of Labor gave out to the states, to $260 billion was given out through the CARES Act and related legislation. According to Department of Labor's own projections, the improper payment rate on that is over 10%. So they're projecting that there's about $26 billion in improper payments in the unemployment insurance program. But what's even more stunning is the fraud rate and the projection on that. And the Department of Labor, OIG, issued a report on this, identifying what the issues are and the control deficiencies. But they're projecting and estimating $8 billion in fraud in the unemployment insurance program. We're taxpayers, that's our money. That is astonishing, that's unacceptable. And part of that becomes the speed and urgency with which we are giving out money, and we over-rely, in my judgment, on self-certification as an internal control. That is not a particularly effective internal control. And the unemployment insurance system is, the way it's set up, it is heavily dependent or solely dependent on the individual states dispensing the funds and legacy IT systems within the individual states and their own ability to catch fraud at the transactional level. And the fraud there is not only local level one-off frauds. There's been, we have on our website, Department of Justice press release on a large fraud ring in Pennsylvania dealing with prison inmates that defrauded millions out of the Pennsylvania state program. That's happening elsewhere. The unemployment insurance program is seeing international organized fraud rings that are involved in this with synthetic identities. It is an area that needs much greater attention. And as Congress looks to and debates additional funding for this pandemic, there are lessons to be learned in the IG's work, across the community. As a community, in the first 6 months, collectively, we've issued 88 reports related to the pandemic. We currently have over 100 ongoing projects. And in that work that you'll again find on our website are the insights that I believe and we believe as a community that are going to help the policymakers make the necessary change, or at least be sensitive to and write into the law things that folks should pay attention to next time around to prevent another $8 billion going out the door to fraud, waste, and abuse. Because every dollar that goes out for fraud, right, is one less dollar to our friends, family, and neighbors in need. So with that, I will end. Thank you very much.
Thank you, Bob. We are going to turn now to Lee, who's visiting us, I guess, from home, but really from the SBA. But Lee, who could tell us a little bit about what's going on in the SBA's OIG office. Thank you, Lee.
Thank you, Dean Tillotman. I'm especially grateful to be on this panel with all these distinguished guests, and most grateful of all to Dean Tillotman, who's taking a chance on me. I haven't been asked to speak publicly since the incident at the Northeastern Regional Pennsylvania Sales Conference, where I accidentally gave a word-for-word version of a Mussolini speech. So I appreciate the risk you're taking, and I'm grateful for that. Some of this has been covered, but very briefly, the CARES Act provided for funding for two different loan facilities within SBA. There's the Paycheck Protection Program, which I'll call hereafter the PPP, and the much less known Economic Injury Disaster Loan Program, which we at SBA OIG call the Agile when we refer to that. The PPP program is the much higher profile one. When you hear about people buying Lamborghinis and things of that nature, that's more often than not the PPP program. the Idle program is generally, in terms of fraud, more associated with the identity theft and the reference Inspector General Westbrook's made to the criminal rings and so forth. But the PPP program has to date done 5.2 million loans worth $525 billion. There was 130 billion left over. I know there's been some discussion about what to do with that money. The Idle program, I think, was provided with $20 billion. And there was a $150,000 cap on those loans. And there was also an opportunity to receive grants when an applicant submitted an application, whether or not the loan was ultimately approved or not, which has also been a source, as you can imagine, of a good bit of fraud. The PPP program is not identical to, but it's similar to SBA's 7A loan program. It's much less document intense, obviously, because of the timing in which they were attempting to get the money out. But the similarities include using intermediate lenders to disperse and process the loans. There is a 100% guarantee on these loans, so the lenders themselves don't carry any risk. And there's also a opportunity for the entirety of the loan to be forgiven, 100% of the loan to be forgiven, provided the funds are used consistent with the regulations. So the use of these proceeds are basically for payroll, and then for rent, utilities, and interest on certain debts. And the percentages initially were 75% payroll, 25% other. It switched at some point from 60% payroll to 40% other. And that change has been characteristic to some degree of my experience with the program, in that the rules have not in large ways, but in subtle ways have changed throughout the life of the program, which introduces a degree of complexity when you're trying to enforce these programs. The Idle program is an existing program. When we have Hurricane Sandy, Hurricane Katrina, 9/11, these large disasters, these loans were, low interest loans were available to both businesses and individuals in order to recover from these. For the most part, kind of briefly, these loans are intended for working capital, which could potentially include payroll. A borrower could get both a PPP and an Idle loan as long as it's not for the same purpose. So seeing that a company received both of those loans is not necessarily indicative of fraud. My specific focus with this has been on criminal activity. And I contrast that to things such as violations of regulations, debates or questions about eligibility, and even questions about the propriety of certain loans. You know, the debate about whether it was important for Shake Shack or appropriate for Shake Shack, or, you know, some of these other large entities to receive these loans. That was not my specific purview. I'm pursuing criminal activity and not those kind of big picture questions. Those kind of big picture questions, should you have them, are probably more fit for Inspector General Westbrook's. As a consequence of my role, which is investigating individual or referrals rather, and working individual cases, I would say my experience is anecdotal rather than systematic. And so as a consequence, so is my knowledge. Very generally, we've seen, and this is about as general as I can make it, we've seen kind of two different kinds of fraud. There's front-end fraud, as I would call it, which is people lying about eligibility and so forth to get the loan. And then there's back-end fraud, which is a misuse of proceeds. It's conceivable that an applicant can say everything true on their application, receive the funds, and then commit the fraud, commit a crime. It's more likely than not that both of those things are occurring, that you're lying at the front end and then misusing the proceeds. If there's anything that you should take as a silver lining in this discussion, and generally, it's the extent to which our law enforcement partners and the Department of Justice have stepped up in this situation. Very early on, when the CARES Act passed, myself and my colleagues at SBA OIG found ourselves being invited to and doing presentations to working groups, task forces, and so forth, set up by individual U.S. attorneys' offices and the Department of Justice. I would also say that the law enforcement agencies that we work with have stepped up in an incredible way. The U.S. Secret Service is intimately involved in idle fraud and is doing an incredible job. The FBI has stepped up. Some smaller agencies that may not be as familiar as those big agencies like the FDIC, Office of Inspector General, the IRS, the Tax Inspector General, which is the IG that oversees the IRS, FHFA, Postal Inspectors, Social Security Administration, DCIS, which is DOD's IG, Department of Labor, and even state and local law enforcement agencies. I've received contacts from detectives in small towns, from investigators with sheriff's offices, from local district attorney's office, and so forth. If you're thinking about the law enforcement community, there has been an incredible effort to step up and pitch in, and regardless of the basic mission of these entities. The last thing I'll tell you is that we went from being, SBA OIG went from being what I would characterize as a sleepy, calm inspector general, where I'd spent 20 years without ever, having to be in a crisis mode, to frankly, our office has been overwhelmed. Our hotline has received thousands of complaints a week. It used to be the hotline at SBA OIG was a very sleepy place to work. I mean, at one point, Creed Bratton worked there for about 10 years to give you a sense of how calm it was. And now it's just absolutely overwhelming. So that is how things look from kind of the ground at working this fraud. It's an overwhelming amount, which is disheartening, but there is an incredible effort being taken forth by just everyone who's a stakeholder in the law enforcement community. And I think that might be some cause for optimism.
Thank you, Lee. I was going to say, after listening to you and Bob, I think both of you deserve a long nap after all of this, whenever that is. I know both of you are going to be incredibly busy for many, many years to come, given what we know of past stimulus programs and funded programs like this. Okay, so now we're going to turn. I don't know what's the accurate way to describe it. I call it the human face, not as though our prior panelists did not have human faces, but the human face of the pandemic, to Chris Cummings, who's joining us. Chris, as I mentioned before, is a CEO and founder of a company of small business and did receive a PPP loan. And he's going to talk to us a little bit about his experience with that. So Chris, with your lovely background, please take it away.
Great. Hi, everybody. I'm Chris with Curiosity Media. Our mission is to bring free, high quality reference and education products to every Spanish English learner in the world. And we do that primarily through the internet's most popular Spanish dictionary site called Spanish Dict, which has translation, conjugation, vocabulary, grammar help, conversation help for about 100 million people a year. So we reach a lot of people, but we're a very small team. We have about 20 employees that work on the company. So when the pandemic struck and everything was shut down, our business model runs on ads. And with the economy in lockdown, the advertising market dried up very fast. So some of the biggest advertisers on the internet are travel industries, car industries, and a lot of their budgets went to zero. So we were staring at very big declines in revenue, totally unanticipated. And the PPP loan program was a small drop of relief. It wasn't going to change the equation fundamentally, but it helped out some. So as soon as the law was passed, we started gathering information on the program. We heard from lawyers and accountants about the different parameters of the program and read white papers to try to understand it and prepared the application before the application was even eligible to be submitted. And that process was fraught with questions about what the law actually required. So one thing that was unclear was whether payroll protection included contractors or just employees. There was uncertainty about the use of funds. There were some things about the percentages that had to go to employee salaries, but it wasn't quite clear about for office utilities. What is office utilities? Does paying for internet count as office utilities? I'm not sure. There's no guidelines or regulations on that. There were a lot of questions, and we reached out to accountants, and we got different answers because actually nobody seemed to know. Because I think that the regulations hadn't necessarily been issued. But we got all of our documentation ready. We got all of our prior quarterly tax returns. We got proof of payroll. We got signatures from owners. We got everything ready. And then we just waited. We bank through Wells Fargo and Capital One, two of the biggest banks, and we've been there for years, and we have direct contacts with bankers that we could call and talk to. And they were very, very, very slow to open up applications. So we just sat on our application for a long time, and the first round of PPP funds just ran out. So we weren't able to apply in the first round. It was very frustrating. I felt like we tried to do everything appropriately. We tried to be ready. We tried to be informed, tried to have all our documents, but the larger banks were very slow. And it's frustrating as a small business owner, but I can completely understand why. It's a massive new program, millions of applications coming into these banks, very low interest rates, not clear that they would make much money from it, super high customer service required for each loan. People had so many questions, they wanted to call the bank to get answers. So the bank didn't have the answers. So they sent out a lot of form emails saying, we're working on it. We're trying to get our system set up. And I got so many of those emails, but they really didn't have the systems or processes to process all these loans. So we applied again on the second round. And at this point, we applied through Wells Fargo. We were trying to apply through Capital One. PayPal also opened up applications, and we applied through them as well. In the end, we did receive the loan through Wells Fargo, but they made a mistake when they were processing it. And because of the way the applications work, we weren't able to correct it because they had already claimed our SBA number. So PayPal came back with the loan at the appropriate amount, but because Wells Fargo had already claimed the number, then we weren't able to move forward with that PayPal loan that would have worked out better. So the process for us, I think, was clouded with uncertainty about whether we would receive the money, whether the banks that we worked with would ever get set up to process the things. Now that we've received the funds, I've probably received a dozen emails from Wells Fargo saying I need to prepare my documents in order to file for forgiveness. But to this day, I can't do anything with those documents because they have no process for me to submit them or to follow through with that. So I guess a couple of reflections is that because the way this program was structured so that intermediary banks were responsible for processing all the applications and had very little interest or incentive to do so, I think that the end user experience was a bit frustrating from time to time. And I also think that there's a bit of confusion about what the PPP loan program is, because traditional loans, you'd have credit checks and history, and you got to do a lot of diligence. And PPP was a loan in name, but is really more like a grant in practice. Like you get the money, you spend it, and then you apply for forgiveness so that you don't pay it back. And I don't think that banks are really in the business of giving out grants because it's just not that much, it's not that lucrative for them. So I think that there's a lot of incentive misalignment from the banks in terms of like, they don't really want to do these loans in the first place. They just don't want their customers to be mad at them. And they don't really get much for doing it. They just get a lot of flack from people saying it's slow or confusing or not working well. And I think that contributes to the problems with, it probably will contribute with the problems with oversight and follow through and documentation and so on, because the primary institution that's interfacing with the businesses doesn't really want to do it from our experience. So maybe I don't know what all the alternatives are. Maybe there's different institutions that could have administered these loans, different processes that could have been in place, different incentive structures. But it did seem from our experience working with banks that this was not a role that they wanted to be in. It's probably still not a role they want to be in. And I think that influences quite a bit the instances of fraud and abuse and so on. And then one other thing I'll say is that I think there's a big context that's important for this, because I think when this law was passed, this was staring down the face of a true economic emergency. And so the desire to get funds out as fast as possible overshadowed the diligence and thoroughness that might go into other programs. So I don't necessarily fault a little bit of sloppiness in how legislation was passed or how it was administered, because the sheer amount of money is just staggering, and to try to distribute it in such a short period of time is very difficult. But with that said, I think now we're in a different era where we've had months to think about it and reflect. And if they're going to talk about new negotiations for new stimulus packages, it doesn't have the same level of urgency that it did in March. And there's probably lessons learned that could improve it for the future. So that was my experience, and I'm happy to talk any more about it.
Thanks, Chris. I appreciate that. I need to get a comment in here about your great background. So you've wowed everybody today. So thank you for that as well, in addition to the very helpful information. Ben is joining us now. I'm going to talk a little bit about some of his reporting related to the PPP program. So Ben, thank you.
Thank you, and thanks for having me on this panel. I've learned a lot in the last hour or so. So I think reporters in general have kind of approached reporting on PPP and some of the other programs. Agile, comes to mind for sure. There have been some good stories on it. Kind of a couple of perspectives. There's a lot of reporting when someone gets arrested, particularly for some of the high-profile cases where someone buys a Lamborghini or a Tesla or whatever the case might be. And then there's been some reporting on some of the audits that have come out and some of the reports that have come out from both agencies and from some congressional committees. We tried to take an approach to try to find potential fraud, on our own without relying on the work of law enforcement or of oversight groups. And we obviously don't have the tools of law enforcement available to us. So one of the our approach in doing, we did a project where we did a two-part project looking at some potentially ineligible loans in the PPP program. And our sort of operating assumption was, there were certain rules that you had to follow in the program. The program was, this was supposed to be a loan for a business that actually was being hurt by the pandemic. If you're Zoom, probably, this isn't the time for you to be signing up for PPP when suddenly your business is doing, great, is doing better numbers than ever before. So that was one thing. And the thing we really focused on was this was supposed to be for existing businesses. This wasn't supposed to be an alternative to getting startup capital from somewhere else. And so we really we worked in conjunction with a group called the Anti-Corruption Data Collective, which is a collection of, researchers, professors all over the country and other folks in the kind of oversight world. And we looked at PPP recipients, and then we compared it to corporate registration data from the website Open Corporates. And we basically flagged recipients that appeared to have been created or to have registered with the state after the deadline when businesses were supposed to have been in existence, which was February 15, 2020. So essentially we were trying to find new businesses because, again, as I said, these people weren't supposed to be getting money. We then, we had our list of, however many hundred potential matches, and we went through and reviewed all of them manually to sort of figure out, okay, which companies really do seem like they are new businesses that we have no footprint of before February. And in our case, actually, we were using an April 1st deadline, so we were being even more stringent. So we flagged more than 75 businesses, and that number may sound like a lot depending on from one perspective, but we also know that that's the tip of the iceberg. The data we were looking at didn't have all 50 states. Again, like I said, we were going April 1, so a company that was created March 31st, we weren't going to capture. But I think what it was telling, what we found when we really looked into those businesses These businesses were businesses that we really couldn't find no footprint of them having existed. And we found lots of other red flags. Once we started looking into the owners of these businesses, we would find that many of these businesses were connected to multiple people. You might have 1 or 2 people who were connected to 4 or 5 businesses that had each gotten loans. And I should say, by the way, these were all loans above $150,000, because all the loans below $150,000, the recipients of those have not been publicly disclosed. So we as reporters can't see that. Obviously, Lee and Bob can see those, recipients, but I cannot. We found a lot of things that really raised red flags, and those are the people we focused on. We focused on people, like I said, with histories of bankruptcies. In one case, multiple people who had fraud convictions in their past. One person who had a previous loan from SBA that appeared to have at least at one point been delinquent, which is again one of the rules was you couldn't have had a delinquent SBA loan to get this money. So we found all sorts of red flags. As we looked more into the program, we realized that, some of this was because, effectively banks were told, rely on the borrower. It's the borrower's responsibility to be honest. They turn over the paperwork to you. And if they tell you, this is how much their business took in last year, or this was what their payroll was last year in calculating how much money they could get from the loan, you were effectively supposed to sort of take them at their word. There were some checks beyond that, but as Chris pointed out, this was not as extensive a process as you would typically undergo for a loan program. So that was one of the things that we thought was very striking, and one of the things that I thought was really interesting for us was to see. We wrote a lot about people where they were connected to multiple loans, we might find that because they had the same address, or when we looked at the companies, they had the same people having as their having incorporated all these different companies. We found a lot of these things that connected them, and which to Shruti's point before, argues for doing some degree of data analysis in trying to find potential fraud within these programs. And again, we're limited in terms of some of the things we have. Theoretically, law enforcement can have access to filings that businesses have made with their state about their payroll in the past. We don't have access to that as reporters. So we wrote a couple stories. One of them focused kind of big picture on a lot of these recipients. And then another one, we really focused on one lender that popped up in our reporting as originating, as approving far more of these questionable loans than any other. It was an online lender called Cabbage. You may have seen their ads on television. Their big pitch is that they approve loans very quickly. Effectively, they have turned over the approval process to machines. They have a formula that makes a relatively quick decision on whether to approve a loan or not. And I think it's interesting what Chris was saying about banks. I think for some of the big banks, my sense is that they may have seen the PPP program as a burden. But for some of the smaller online lenders like Cabbage, I think this was really a boon. Cabbage was struggling at the beginning of the pandemic. They were, furloughing employees. They were in real trouble. The PPP program rewards for a lender, it rewards volume. You get paid a certain percentage, a sliding scale from 5% to 1% as a fee for approving these loans. And you actually get a higher percentage on smaller loans. Now, you might say, okay, well, larger loans take more work, so and they're bigger, so the dollar value might be higher for those bigger loans. But if you have a bunch of small loans, that money adds up pretty quickly. And if you as an online lender that has this kind of online algorithm, if you can approve these loans very quickly, potentially you can make a lot of money doing this without laying out the same resources and time and effort and cost that a big bank might need to go through these loans. If a big bank is running it through, for example, its sort of typical anti-fraud program. So in Cabbage's case, as I said, they accounted for far more of these loans in our analysis than any other lender, and it really was a boon to them. They were struggling. They made a ton of money. We estimate somewhere in the neighborhood of upwards of 300 million in fees from this. And they made themselves an attractive target to be acquired by American Express, which acquired them late this summer. So you go from beginning of the pandemic, they're furloughing employees. There are real questions about this company's viability to now they're a very attractive target for American Express and they get bought out by the end of the pandemic. For them, I think it really was a boon. And others have reported, Jessica mentioned at the beginning, a report that Project on Government Oversight did. A lot of what we've seen in a lot of the prosecutions that have come out so far is that a lot of these so-called fintechs, these online lenders, which don't operate quite the same way as traditional banks, they tend to be associated with a lot of the loans that so far have led to charges being brought against them. So not to say that the fintechs are necessarily did a terrible job. Certainly, we're talking about small fractions of the number of loans that they ultimately overall approved. But I think for us, that was one of the striking findings in our reporting was, this kind of seeming relationship between the two. And I think, what I'm kind of interested in is we've obviously all read stories and seen stories about the recipients of these loans potentially being, facing criminal charges and being under investigation. But there was an interesting story today in Reuters about whether some of these lenders themselves are going to face scrutiny. I think that's an interesting question, particularly if other lenders seem to follow that pattern that we saw, which is that there does seem to be a differentiation between the fraud rates of different lenders. If sort of the worst performing lenders, if they will face consequences for that. And to me, that's one of the big questions for me going forward.
Thank you, Ben. That's fascinating. I don't know if Bob or Lee is able to answer Ben's last question about the lenders. Are either of you able to respond to that, or you can shake your head if no? Bob.
Yeah, I don't have any additional details on it. I'm certainly, there is a desire across the law enforcement and regulatory community to make sure that anybody that has any culpability in wasted dollars is held responsible. So whether it's being addressed now or will be addressed later, I can't answer, but I'm fairly confident it'll be addressed at some point. So
at this point, I would just want to remind everybody who's attending to just feel free to keep asking questions in the chat function or the Q&A function, whichever one you prefer. Feel free to go ask those questions because we are answering them now. I also just want to give a chance really quickly before I ask some of these questions that we've received so far out loud to the panelists. Do any of you have any questions that you want to pose to each other based on your initial presentations, or to respond to something that somebody said? You're welcome to jump in if there's anything somebody said that you want to do or address. And hearing overwhelming silence, I will guess that the answer is no. Quickly, I'll first go with a question from Kim Courtney, who asks, hi Lee, do you have any general recommendations for small businesses who do not have attorneys and accountants assisting them to help them avoid unintended fraud through the PPP program?
So in my, again, anecdotal experience, my observation is that I did not see any borrowers who utilized either an accountant or an attorney. At least they didn't make a disclosure to that, or there wasn't anything to suggest that. In terms of, so I don't think it's unusual to not rely on someone like that. I think the intent of the SBA Form 2483, which is the application, is to be as simple and straightforward as possible. It is 2 pages. The eligibility requirements are fairly simple. You had just to be in operation on February 15th, 2020, have employees and have payroll for those employees. There are additional things you have to do. So, disclosures you have to make with respect to criminal history, for example, previous history with SBA loans, bankruptcy, things of that nature. But the simple answer, and this probably isn't even all that helpful, is simply to make all these disclosures honestly. It's an enormous mistake to think that I have 20 employees, but I'm going to say I have 25 employees so I can get some additional money to do this or that. If you respond to everything honestly, and then you use the proceeds consistent with the regulations, which may also be a temptation, is if you've developed subsequent bills during this time that you think you need to pay, and those are outside the parameters of the PPP program, you'd be making an enormous mistake to use those funds to do that. So I do think the intention is to make the process, at least in terms of the application, as simple as possible. And I think that's one way that there has been some degree of success. It's not an onerous application.
I'm going to keep you on the hot seat a little bit longer, so thank you for that. Paul asks, when you say thousands of hotline calls, how many tips of fraud, waste, and abuse come through related to the PPP program? Is the SBA IG looking into the economic uncertainty certification of the PPP applicants? And if so, what support is required to show economic uncertainty?
I'll tackle the first one first. We are here at SBA OIG, all PPP all the time. And all of the, when I mentioned the hotline uptick in hotline complaints, those are almost all related to PPP and Idle. I would say it's probably runs at about 99%. We, prior to all of this, SBA OIG did a lot of, beyond loan fraud, we did a lot of small business contracting fraud. And so I would have suggested to you prior to this situation that the hotline complaints ran about 70-30. 70% would have been small business contracting fraud, and then 30% would have been loan fraud and other things. Now it's almost all PPP and Idle fraud. With respect to economic uncertainty, there was a updated rule that basically assumes the need for this and waives the requirement to certify as to economic uncertainty for, I believe, loans under $150,000. For the loans beyond that, the application itself doesn't collect specific documents or data that prove that the loan was required due to economic uncertainty. So I think, and I'm speaking solely from the perspective of pursuing that criminally, it's going to be difficult after the fact to claim that there was some false information provided beyond indicating that there was economic uncertainty. And, you could arguably suggest that a company whose revenues increased during this, for whatever reason, was not dealing with economic uncertainty. I could not speak to how palatable that argument would be to a federal prosecutor. I'm not familiar to date with any specific criminal referrals that have been based on economic uncertainty. It's possible Inspector General Westbrook is familiar with those. But as it stands right now, the low-hanging fruit are the companies that didn't actually exist. The companies that submitted falsified or fully made up tax documents and so on and so forth. So I think maybe the second tranche of investigations down the line, it's conceivable that those kind of cases might come to the fore. But right now, we're really tackling the most egregious of the PPP ones. And with respect to Idle, we're focused on these large criminal rings that Inspector General Westbrook's discussed earlier.
Thank you, Lee.
Add to that, we
Go
just
ahead.
had a presentation at the PRAC by the IG for SBA, Mike Ware, and in terms of raw numbers on their hotlines, they had about 700 hotlines last year, and they have about 70,000 hotlines to date this year. So, a 10,000% increase in their number of open cases. It's amazing. Lee is actually with us today because they are very, very busy.
We're grateful to everyone that is here for sure. A question came in for Shruti or anybody else. You laid out several problems areas with oversight for the CARES Act, as well as your recommendations. Do the current conversations going on between Pelosi and Mnuchin include those recommendations, or would these be items that the next Congress would need to implement? Also, are there rules that the SBA and other agencies can implement, or does this require statutory changes?
So great question, and I'll tackle that first, and certainly Bob and others should feel free to jump in. In terms of our recommendations, we've made sure most congressional offices have those, and certainly we advocate for those to be included. From what I understand on the negotiations, that they do want to reach agreement on dollar amounts and specifics right now, but on the language, the agreement will come perhaps later and the vote will come later. So there is still time to push for more of these recommendations to be included in terms of recommendations for what Congress has to do. But there are certain things which agencies can do themselves, right? In terms of the presumption towards transparency, in terms of responding to requests from IG offices, and generally what the administration can do in terms of nominating people for open IG positions. All of those things can be done without requiring any statutory change. And also following the current best practices for whistleblower protection. While we want additional protections to be baked into legislation, there are so many things that can be done without actually requiring additional legislation. And one of the most important things would be that presumption towards transparency. And I was listening to really what Ben said. Just having more eyes on the data would enable work by great journalists such as Ben, other nonprofits, to really bring out and help us detect fraud quicker. So I think I would encourage, and that doesn't really require any additional legislation.
Anybody else have thoughts on that? Okay.
Jessica, can I beg your pardon, may I clarify something I said just a moment ago?
Of course.
With respect to economic uncertainty, it is not waived for under 150,000. It's for 2 million, for loans under 2 million. I apologize. And it doesn't so much waive it as it accepts the certification and it implies it. So it's not waived. It's just there's no need to prove that. So I apologize for misspeaking.
No problem. Question came in about fraud investigations regarding Section 3610, which involves government contractors. Do any of you have experience with fraud investigations into violations of Section 3610 or done research into that area? Okay, we will skip that. Sorry to tell you. Okay, Kval asks, to extend Ben's point, is the lending of stimulus packages procedurally similar to a normal banking loan? He does quite a few of these fraud investigations on behalf of lenders or / banks in India, and a lot of what Ben raised was similar to what he's experienced. So maybe that's for Ben or even Chris's experience. But Ben, are you able to address that one?
I mean, I think it's clear that there was less required. I mean, I think one interesting point of comparison is the Main Street Lending Program, which is a program that was authorized through the Federal Reserve. The key difference with the Main Street Lending Program was that it was a loan rather than a PPP. The PPP, which is effectively a grant, as Chris said. But in that program, the banks kept a small percentage of the loan on their books, so they had a slight bit of responsibility for it. The Fed assumed most of the responsibility, but the banks, made pretty clear that, and the Fed made pretty clear that they were going to be looking closely at their underwriting standards. And whereas we've had, hundreds of thousands, millions, in fact, of PPP loans, we've had, somewhere in the neighborhood of like a couple hundred of the Main Street Lending Program loans. Now, granted, it's not free money in the sense that PPP could conceivably be seen as, but I think it also speaks to the fact that the Main Street Lending Program required banks to go under very strict underwriting standards to approve these things, and there's been very few of them versus PPP, where banks were basically told, do this as quickly as you can. And I think it's important to remember that could be part of the policy design. Speed was important here. You didn't want these applications to spend days or weeks going through a rigorous process. When businesses were at risk of shutting down the next day. So there's a valid point to be made that there is a trade-off between the certifications and the requirements in the outset, and the speed with which it's delivered. And I talked to people who said, listen, maybe a certain level of fraud is acceptable. Maybe that's just what we accept as the cost of doing business. If we lose a certain amount of these loans that go out to places they shouldn't go out to, well, maybe that's actually worth it in the grand scheme of things if it helps prop up the economy at a moment when it's teetering. So I think that's important to keep in mind, which is, just because there turns out to be a fair amount of fraud in these programs, that doesn't mean that the programs failed. The programs may have worked very well, even with some fraud having occurred, because the broader goal here was to prop up the economy and to keep small businesses open as opposed to having them shut down.
Ben, and Chris, I saw you nodding your head along. Are you able to speak to your experience as relates to this question?
Yeah, I think it's a totally different process to get this loan. You basically just had to check the box saying, yeah, I was a business and had employees, and here's how much I paid them, and here's the records of it. And a loan, you have to show credit worthiness. This is like the opposite of that, because basically they wanted to get the money to the people who were likely to go out of business, like because they were small businesses and the economy was in lockdown. So yeah, I think it was an entirely separate procedure, and that's probably why it was slow and problematic. Yeah.
One question I had to follow up from it, you had said your experience was so slow because you used some of the bigger banks. You had mentioned before, this is offline when we were talking before, that people's experiences were different with smaller banks. Are you able to maybe talk about what you're aware of and just how the disparity depending on what lender you went to?
Yeah, I probably talked closely with 2 or 3 other small business owners that applied for PPP, and the ones who got it fastest, the person I knew who got it fastest was a person who knew the president of a bank at a small local bank in a credit union in the South. They were just kind of friends on the golf course, and they got the thing through very fast. And I think that's in part because they didn't set up all the procedures that larger banks did to avoid litigation and problems later. I think they were just going on a basically, I know you, I know your business, I know this isn't fraud, so I will get it through quickly for you. And actually interesting, it was very hard for businesses who didn't already have a bank account at a bank to get the loan, because there's all these procedures just to get the bank account to prove that you're a legitimate business. So yes, I think smaller banks didn't have all the procedures of Capital One and Wells Fargo, who are probably looking at this more from like a, how do we mitigate our risk and do we really want this stuff point of view, versus Ben, I'll add, I think one of the reasons Cabbage was so eager to give out these loans is that in the banking industry, the biggest problem is the cost of customer acquisition. And this was like an unprecedented moment in history where like millions of small businesses were ready and willing to sign up for an account and shopping around for a bank to do business with. And so Cabbage set it up so that they could just get as many new accounts as possible. And I think that's partly what American Express bought is, oh, you now have business relationships with lots of small businesses, which is traditionally extremely expensive, extremely hard to do. But in this moment of desperation, lots of people were looking for the bank that could get them the money quickly.
If I could, I was going to circle back to what Ben had mentioned, which I think is really at the heart of the matter, right? Is that's balancing with expediency, with transparency and accountability. Lee's office has dealt with this historically in the disaster loan area, right? In times of disaster, you have to give the money out quickly, and no IG is ever going to accept any fraud rate, right? We have to have a zero tolerance for fraud. But the reality is cost of controls with management and policymakers need to make a decision on what's an acceptable fraud rate in normal times. This crisis is at a whole other scale. So the brazenness and the volume of fraud that you're seeing with the PPP program, really, in my view, it goes to the heart of undermining public trust in government. Can we as a government reliably and consistently give aid to those in need and not be defrauded wantonly by anybody that's got their hands out and can reach into the pocket? And that's the crisis that we're dealing with now. Is if we were to do it all over again, yes, there's an acceptable fraud rate, but did we exceed it in this instance? And what can we do next time to, you know what, even if it's a speed bump and it slows down the underwriting process a day or 2 or 3 days, what is the acceptable control that you can build into the process so you're not relying solely on self-certification for this or other programs?
And I would really echo what Bob Westbrook has said, that while there might be an acceptable rate of fraud, you want to try and keep it as low as possible. And secondly, I don't think all is lost just because people who shouldn't have gotten a PPP loan have gotten it. There is still a forgiveness process, and a lot of fraud can be detected during the forgiveness process if you ask for reliable third-party documentation to support the forgiveness of the loan, which many banks are asking for. They are asking for third-party documentation. And certainly that's an avenue, not just for the SBA, but for banks themselves to detect suspicious behavior and instances where the money hasn't been used for what it was intended. So certainly just because the money has gone out of the door doesn't mean all is lost. You can claw it back, and certainly there is still a process even within the PPP program, especially during the forgiveness phase, to detect fraud.
One thing that I was thinking about in this question between the amount of oversight and the speed at which the money can go out is, Shruti, from listening to your recommendations, one thing that occurred to me is a lot of them don't slow down the speed at which money goes out. You could allocate more for Inspector General and it doesn't slow anything down. You could make the data more transparent after the fact and it doesn't slow anything down. There are certain types of like checks that you can do with data when people apply that don't slows things down. So I think there's definitely a tension if you want to go through a full loan credit check, like distribution process, that would be too slow. But there are a lot of things that you recommended that don't seem to slow things down at all. And maybe that's changed my thinking a little bit on the topic, thinking about those.
One quick follow-up is when we talk about, at least in our anti-corruption program, we talk about the importance of transparency and the various overlapping mechanisms that we have in government, and I think that's something that Shruti's talking about with improvement. We rely not only on of obviously referrals to come in through tip line, through and auditing that's being done, but for this information to be transparent so that civil society like Shruti's group or the media like Ben can find this information and analyze it and get this information out to people to assist you. Do we feel or do we think that there are ways in which transparency could be enhanced with the future loan? And I don't know, whoever wants to take this, what ways could transparency be improved?
Why don't I take that first, and I'd be really interested to hear from other people. I mean, I can give you two very, very specific things where transparency can be improved. For example, the PPP loans. I mean, the recipients about 150,000 are being disclosed. Disclose all of them. They are receiving federal taxpayer dollars. We should know who receives it. And certainly people who receive these loans would not, if they are legitimate businesses trying to save their businesses, will not actually have an issue with that. Secondly, I would say that, we are talking a lot about the PPP loan, but there is also this big 500 billion fund, which is that discretionary Treasury lending program. For that, I would say that the Federal Reserve is allowed to have these closed door meetings under the CARES Act. And I really do think they should disclose transcripts of those meetings so we can have insight into how decisions are made. So I would say two specific transparency things. Agencies themselves, of course, should really have a presumption towards transparency and should not be resisting any attempts to put out more information. The reason I say it is it's in our collective benefit. We can't view IGs or the media completely as adversaries. There are our allies in trying to help us detect fraud and make sure money reaches the intended beneficiaries.
Trudy, we've had a few more questions come in. Richard asks, is there any reason to believe that recipients who meet the full loan forgiveness amount in 8 weeks as opposed to 24 weeks had less economic uncertainty? Does anybody know? Maybe speak to that.
I don't know that that would necessarily be suggestive of fraud or an indicator of fraud. There's, as I mentioned, there's variability to how you could, fairly narrow, but nonetheless variability on how you can use the PPP proceeds. If a business elected to use it exclusively for payroll, which I've seen, and sought to do that within an 8-week timeframe. That's a permissible use of those proceeds and wouldn't raise any suspicions whatsoever. It's possible I'm wrong about that. It's possible at the end of the day, we'll see that there is a distinction between, or relationship rather, with fraud between utilizing it within 8 weeks or 24 weeks. But to date, I haven't seen anything that suggests that.
Thanks, Lee. Oh, Shruti.
Just to add to what Lee said, I also agree with him only in that you may meet that 60% or that whatever 75% criteria for payroll within the 8 weeks itself, which doesn't mean that you didn't need a larger amount of PPP loans to cover you for the 24-week period. It just may mean, according to the calculation and the loan amount that you ultimately got approved for, or the grant amount that you ultimately got approved for, you could utilize it in the 8 weeks. It certainly doesn't mean that you don't need more money or you wouldn't have appreciated extra money for a longer period.
Thanks, Shruti. What kind of feedback is PRAC or SBA getting from subpoenas that DOJ has issued to big banks related to CARES Act related fraud? What can you say about the relationship between PRAC and investigations that are going on?
So I'll start and then I'll kick it to Lee. So the PRAC hasn't issued any separate subpoenas itself. So that's an easy one to answer. We've got no feedback from banks because we've not issued any subpoenas. What we do is interact with, we meet weekly with the IG community and track the investigations that are ongoing. But the subpoenas that come out, they're for discovery purposes, and agents like Lee and investigative analysts go through it to identify, evidence of fraud. So Lee, do you have anything to add?
Yeah, it's a great question. If you're talking about the subpoenas that required a great deal of information from banks, that's not something that has come across my experience. And I think the reality is, if it had done so, it would be premature to make any kind of disclosure or provide any information on what that communication was. I'm sure with patients down the line, you'll see what, if any, results are going to come as a result of those subpoenas.
Thanks, Lee. And then the last question that we think we have time for before we have to wrap up, or maybe we have time for one or two more, depending. What efforts, promising or not, to track and recover funds identified as fraudulent or improper, any good practices that you've uncovered so far with this pandemic that relate to tracking these fraudulent funds? Anything that's been a best practice generally?
Yeah, it's, we're still very much in the early stages. Although this question sort of relates to a question somebody else had earlier about, our agencies, do we have any work showing if agencies have implemented the GAO's fraud risk framework, right? And that's the root cause problem. If agencies had done that sooner and had controls in place, it'd be much easier to identify these dollars and to recover it. The things that are being done, there are tools out there, right? So one of the biggest tools is the Improper Payment Act. So all agencies identify their improper payments, report it, they have to have controls in place. But then at the Treasury level is the Treasury Offset Program, right? So if we identify debts, whether through criminal cases, civil or administratively, as long as the agencies and the IGs promptly report those debts to Treasury, there should be a hold on any future payments coming out of the Treasury, whether it's tax dollars, refunds, or anything like that, federal contracts, that sort of thing. So those are, I think that is a Treasury Offset Program is a very effective tool when it is used.
And I would add to what Bob said, kind of at a micro level, from an agent perspective, in terms of following funds, we do have tools that are very effective to do that, law enforcement tools that existed prior to the pandemic. The other thing I would add that hopefully, again, provides a little bit of comfort to folks is I have seen firsthand examples of PPP loan landing in a borrower's bank account, the bank account being separate and distinct from the lender, and that bank that received those funds saying, this does not look right. We are not comfortable with the receipt of these funds, and we are not going to hold these funds, and now provide the funds back to the lender. I'm not saying that happens all the time, but there are instances where that has occurred. And to the credit of the financial institutions involved here, they're not going to, they don't want to turn a blind eye, and so there are been some exceptional efforts made in that regard.
Thanks, Lee. We did get a question that came in about the release of the names of borrowers of PPP loans under $150,000. I don't know if Bob or anybody else is, or Lee is able to weigh in on their thoughts on that. I don't know if it's possible because it might ask you to take a policy position, but if there's anything you're able to share with respect to that, that'd be helpful.
Yeah, no, I mean, I think Shruti made a very compelling argument for all taxpayers why under $150,000 loan should be reported. It's a decision that Treasury and SBA and the administration made based upon their interpretation of the application of privacy laws. The matter is now in federal court in FOIA litigation. We are aware of that. We've let both SBA and we're letting the Hill know sort of our position on it. But we believe this data should be available, consistent with privacy laws.
Lee, any thoughts, or no follow-up from you?
Yeah, that's that. For whatever reason, no one at SBA or in the government has consulted me on that, and so I don't have anything to provide on that.
No problem. With that, we're fairly close to the end of the hour. I didn't know if anybody else on our panel had any additional thoughts that you wanted to share before we release everybody to their lunches. Oh, got one more. Does the fact that nope, it got cut off. Okay. It got cut off. Does the fact that PPP is a loan help maintain confidentiality of the loaners? No, anybody? Loanees?
I would say at this point, it's more of a grant than a loan. If it's not forgivable, then I guess it becomes a loan. But otherwise, it is basically getting a grant. And when the U.S. gives out foreign aid, we are transparent as to where it's going. So we should extend that same transparency internally. That's certainly my view. The only closing point I do want to make is to thank everybody, especially our representatives from the government, and really encourage everybody who's attending to strongly support the work of inspectors general. We really do have to see them as allies and really commend them for the great work that they are doing, and sometimes under very difficult circumstances, particularly because they are making recommendations which are sometimes, well, in most cases, critical of the agencies they are in charge of and critical of the administration.
All right. Well, with that, I want to thank first our panel. You guys did an incredible job, so thank you for your time, particularly because you sing thousands of tips per week. You probably have a lot to run to after this. So thank you for that. And then, of course, thank you to everyone who joined us today. We really appreciate it. And with that, have a great afternoon, everybody. Take care.